Hi there, welcome to Kneppy Invest. Not often do I read a half yearly or yearly report from a company and I get a headache simply because I'm reading that report. But that's exactly what happened with oOh Media's half yearly report this year. I was requested to take a look at it from someone who watched one of my videos, and I thought, why the hell not? I haven't looked at oOh Media for quite a few years. I was actually following this company when they relisted on the ASX because they initially listed on the ASX, went private, and then relisted, but I'll talk about that later. So I really haven't looked at this company for a while, and I thought a good time to reintroduce myself to this company. Unfortunately, when I went through the three reports they did release on the day, so they released their half-yearly report, a media release, and then a presentation. Just the amounts of, I won't say discrepancies because I know exactly what they did, but if you didn't know what they did, you would have been completely confused. And initially I was confused about what the company was doing or showing in these three reports, because you could say there were some serious discrepancies in there. So I'm going to talk about that mostly in this video because after I did read and understand, it did take me a little bit of time to understand what they were doing, I was just fed up and decided to go no further with researching oOh Media. What does oOh Media do? They're all about advertising, particularly public space advertising. So you walk around any sort of city and you might see some billboards advertising, and that could be oOh Media. So a lot of different areas where they do advertise. And because they advertise in public spaces, they have to spend a little bit of money on renting out those spaces. That's very important as we discuss what confused me, the discrepancies in their half-year reports, and so on. The company was founded in 1989, I believe, by a guy called Brendan Cook. And he actually was a CEO of this company for about 30 years until almost 1 year ago. They have been ASX listed twice between 2002 and 2012, and I believe private equity did buy them out, and then that private equity decided to relist them on the ASX in 2014. So they've been listed on the ASX for 2 periods of time, and the most recent period is for the last 7 years. The new CEO is Cathy O'Connor. She began in January of 2021. I didn't see how many shares she does hold, but Brendan Cook does own a fair few, but not a large amount. And the largest shareholder is HMI Capital. They have 10.7%. The market cap of oOh Media is $1 billion. That's at a share price of $1.68. And the ticker code of the company is OML. The first thing I usually do when I see half-year results released by a company is I go to the Appendix 4D, I think it's called, for the half-year results, and I go straight to the cash flow statement, and I work my way backwards from there. Revenue, 251.6 million, which was up 23% from last year. The operating cash flow, 81.4 million, which was down 37% from last year. Now, this is where it becomes interesting for me anyway. So that's the number I read from the cash flow statement. The other thing you got to take into account here is the leases they pay to rent out those public spaces to advertise. And for the half year, that was 53.8 million. This is very important here because when it comes to the reason why I was confused and why you might find some discrepancies is how oOh Media deals with their leases, because there were some accounting standards changed 2 years ago, AASB 16, and they have decided, maybe I shouldn't say this quite yet, but it's just the way oOh Media is dealing with their leases, which did cause me some confusion. Net profit after tax, negative, so this company is not profitable based off their full-year or half-year numbers. That was up 67% from last year. So even though they're not profitable, they're not quite as unprofitable as they were last year. And the net profit after tax and before amortization, 1.9 million, which was up 114% from last year. Net debt, according to the business, was $94 million. Now I'm going to talk about why I was initially confused with their reporting. And the first thing we'll look at is the operational cash flow statement, which is always the first thing I look at. And there's no confusion here initially. Net cash generated in operating activities, 81.4 million. That would be the number that is reported if you go to Yahoo Finance, Google Finance, Guru Focus, Ticker, Wall Street Journal. That's the number. All those places would report the cash flow from operations for oOh Media. The other thing I look at here is down in the cash flows from financing activities, which is the payment of finance lease liabilities, which was 53.75 million for the half year. And I'll show you in the next slide why I look at that, because of the change in accounting standards in 2019. So we're going back in time here to their 4-year results for 2019, which was released in February 2020. And the new accounting standards came into effect January 1st, 2019. It was called AASB 16, and it had to do with leases and how they deal with leases on their financial statements. And this is, we're going to look at the cash flow from operating activities and the cash flow from financing activities. It's very important to know what's happening here and how companies had to deal with lease liabilities with these new standards. And we're looking at 2019 and 2018. And if you look at the cash flow from operations, comparing 2018 to 2019, you would think this company had a sensational year, because the cash flow from operating activities increased from $71.1 million in 2018 to $237.2 million in 2019. But you had to understand this new accounting standard and how they were dealing with lease liabilities. And you can see the difference when you go to cash flows from financing activities and go to payment of lease liabilities. In 2018, payment of lease liabilities was only $65,000, and then in 2019 it was $146.6 million. So these new standards said that the lease liabilities had to go into financing activities. They weren't an operating activities expense. And I don't know why, I'm not an accountant, but it does seem to me if you are leasing something out, and that's a permanent thing. For instance, oOh Media, if they want to advertise, they have to lease out public space places to advertise, and they have to spend money on that. It seems to be an operating activities. But I'm not an expert. I'm not the person who decides these accounting standards. And that's why the net cash, or the operating cash flow for this company, jumped up by a significant amount between 2018 and 2019. It was just because they had to deal with lease liabilities in a different way. Now we go to the part of the half-year report that did start really confusing me for a period of time. That gave me the headache. I worked my way backwards in the half-year report, and the cash flow statement was on page 18. There was no confusion there whatsoever. But once I got to page 13, there was a bit of commentary on cash flow generation, and there was this nice little table. And in the middle of the table, they had a net cash from operating activities that equaled $27.7 million. And my instant thought at that point in time was, why is that number so different than the number they reported in the cash flow statement? And at that point in time, I was thinking, was I looking at the right thing? Was I doing something wrong? I don't know. That number should be the same as the number we saw in the cash flow statement, which was 81.4. I was completely confused at this point in time, and I was going all over the place. I could have saved a little bit of confusion if I just thought the number between 81.4 in the cash flow statement and the net cash from operating activities, 27.7, is about 53 million, which was lease liabilities, but I just wasn't thinking that at that point in time. And the other giveaway in this little table was on the top line, Ebitda, 33.3 million. And then right next to the Ebitda, they had in brackets pre-AASB 16. And if I actually did look at that line, that would have been a little bit of a hint about what management were doing in this table. After I saw that table, I was really confused. I was going all other places. I went to the presentation, looked at the presentation, and in fact, the presentation caused me even more confusion, which it shouldn't be. It should clear up any confusion, and that's the main reason their half-year reports, the three reports they did release, the media release, the presentation, and the half-year report caused me headaches because of that confusion, because I was seeing different numbers they were presenting to what I was seeing in their financial statements. It was giving me an absolute headache. If we go back to page 1 of the Appendix 14 half-yearly report, they do give numbers here. And again, this was a bit of a clue, because if we go to the Ebitda numbers here, which is the last 3 rows, we have a statutory and underlying Ebitda, which was 113 million. And just below that, they gave us an underlying Ebitda pre-AASB 16, which was 33.3 million, which was the same top line in that page 13 table. And again, that should have been a bit of a giveaway about what exactly management were doing. Then, when I looked at gross profit that was reported in their profit and loss statement of 179.8 million, and then when I looked at the presentation, they reported gross profit as 106.9 million. How can you say the gross profit is one number in the profit and loss statement and then report it as a different number in the presentation? Everything should align. But again, in that presentation slide, they do say profit and loss pre-AASB 16. And again, I completely missed that. I was just so confused about why all these numbers were completely different from the financial statements to what they were presenting in their presentation. It was driving me absolutely nuts. And this was on page 5 of their presentation, the key financials of the company. And they did have a pre-AASB 16 at the top of this table. But at that point in time, I just saw in net profit after tax, $3.9 million loss, even though in their financial statements, that was 9.3 million. So that caused even more confusion. I was thinking at this point in time, what is the hell is happening? I'm going to have to actually speak to the company because I'm absolutely losing it. Why are the numbers in the financial statements completely different to the numbers they're presenting? And finally it did click. It wasn't until I got to page 26 of the presentation, and I believe this was in the appendix section, so you have to go through all the main part of the presentation, and a lot of people would just completely ignore the appendix part of the presentation. And this was called AASB 16 reconciliation. They had 2 main table or columns here. The first column was the half-year numbers pre-AASB 16, and the second column was post-AASB 16. That post-AASB 16 column was the numbers reflected in the financial statements, and the pre-AASB 16 column was the numbers reflected in the presentation. And this was definitely the aha moment for me. And this is where I completely understood what management was doing and why in the cash flow statement we had operating cash flow of 81.4 million, and in that page 13 table they had operating cash flow as 27.7 million. The difference between those two numbers was the lease liabilities of 53.7 million. That's exactly what they were doing and trying to reflect, saying they don't truly believe that neglecting lease liabilities in the cash flow statement and the changes they had to make because of these new accounting standards is a good representation of how the company is performing. On page 5 of the presentation in footnotes, so very small writing, they had this little bit of commentary that pre-AASB 16 results highlighted as these provide the most meaningful financial results for understanding underlying earnings and cash flow expectations. So even though we've had these new accounting standards come into effect from the 1st of January 2019, oOh Media have decided that they should still report those pre-ASB 16 numbers, and I don't completely disagree with them at all. I just wish they could have a little bit more clarity about exactly what they're doing, because it did cause me quite a bit of confusion, and because of that confusion, I didn't give up, but I decided not to do any more research on this company because of the headache that it did give me. In the end, even though oOh Media really is sort of reporting the cash flow from operations as, was it 27.7 million, all sites, Ticker, Guru Focus, and Wall Street Journal here are all reporting cash flow from operations as 81.4 million. But you have to understand that oOh Media is paying a fair bit of leases to rent out public spaces for their advertising. And in my opinion, that is a part of their operational cost structures, and you have to take that into account. So even though the operating cash flow is quite impressive at 81.4 million, I don't believe, just like management don't believe, that is a true reflection of how the company is performing. And the other metric that this change in accounting standards has affected is Ebitda. And if I remember correctly, it's because lease liabilities have to be amortized. I could be completely mistaken. But when you look at pre-AASB 16 Ebitda to post AASB 16, you can see a huge difference in that number for oOh Media. So post or pre would have been 33 million, and then post 113 million. So a massive difference of $80 million depending on how you deal with lease liabilities. Now let's have a look at the weekly chart for oOh Media, going back to when they relisted on the ASX back in 2014. Share price high for this company was in 2016 when it got to about $4.60. The share price has been under pressure over the past few years. In fact, just prior to COVID-19 financial panic, the share price was falling, and it really fell quite significantly during the panic, which makes sense because you would think advertising is one of the costs that a lot of companies would actually decrease quite significantly when times are tough. That's definitely true through depressions, recessions, that sort of thing. And that's why oOh Media share price fell from the $3 range to a low of 60 cents. And we haven't seen the share price recover quite to those pre-COVID-19 levels just yet. We actually have seen the share price consolidate over the past 9 to 10 months in between about $1.50 and $1.90. We have seen a bit of a good rebound in share price over the past few weeks, particularly after they've released their half-yearly report. And if the share price does get above $2, that could be a good sign that a new uptrend is developing in oOh Media's share price. That's all I have for this video of why I personally hated oOh Media's half-yearly report. Nothing at all to do with the numbers themselves. They could have been absolutely fine. It was just that I did find a bit of discrepancy between the financial statement numbers and the numbers that oOh Media presented in their presentation and their media release. I wish they were a little bit clearer in why there was that discrepancy or that difference. They might think they were being clear, but for me, maybe I'm not the smartest tool in the shed. I did find a little bit of difficulty initially to why there was a difference. So I do wish they were being a little bit clearer about exactly what they were doing in their presentation. That's all I have for this video. Hope you've enjoyed it. If you do have any questions about oOh Media or any other companies on the ASX, please leave a comment in the comment section. Otherwise, I'm not a financial advisor or an accountant. And if you do need financial advice or an accountant, please make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.